So we at least should talk about the market today because it was pretty crazy. It's flat overnight, but the S&P was up almost 2%. That's like a 2 sigma day. What I find amazing is Russell 2000 value stocks were up almost over 5.5% today, which is just crazy. Bonds were up a bunch. Bond funds are up over 1%. And the 10-year Treasury is back well below, 19 basis points. It's moved since we had our class earlier. So who said that? Oh, maybe none of y'all are in that class. Yeah, 19 basis points. One standard deviation is 6.5. So that's like a 3 sigma event in one day. That's pretty huge. Reacting to a slight beat on CPI, they were expecting 3.3 and they got 3.2. So that's all, obviously the market's waiting for the Fed to start cutting rates when stocks and bonds both go up at the same time in massive amounts. That's a pretty rare day. Usually if the stock market's up a bunch, bonds are down. But this is a case where they're both up strong. So a huge, huge day. And I don't know how your individual stocks are doing. So this is the kind of day, your paper 5, you're talking about beta. This is the kind of day where you kind of assess your beta. So Jose, you're doing a high beta stock, right? So you would think it'd be up a bunch today. And it was up 6% today. So that makes some sense. I don't think any of y'all have low beta stocks that I can think of. Maybe Deere. Oops, that's not Deere. Up in line with the market. Well, actually up quite a bit, much more than, because this is a large company, not a value stock. So yeah, big days like this, I'm just curious, like, well, I got a high beta stock, it was set up a bunch today or not. You can look at a UPS, about 5%, FedEx. Wow, FedEx was up even more. Why is that? Did they announce some news that was specific to them? Are they more exposed to interest rates than UPS? So big days to me are days of insight. Is there something going on? So I'm just kind of curious, what could be impact here? A firm like Lilly, I wouldn't think I had such a big day, and they were actually flat or down today because it's a pharmaceutical. It's not really it's kind of a low beta. Why they're negative, who knows? But so interesting. You would think a Walmart would be up less in the market today. And they were actually down today, flat, and that kind of makes sense. If the economy is going to do well, when do people go to Walmart? When the economy's weak and inflation's high, they get by cheap. So that's kind of bad news for them. I forget you're doing Costco, Mohammed? Do you think Costco would be flat? No, Costco is up in line with the market. So yeah, big days to me are important. Also, with interest rates down a bunch, firms that have a lot of debt rely a lot on borrowed money like F&D, because people are having to borrow money to remodel their house. Lower interest rates can be huge for an entity like that. It's pretty material. All right, so what we want to do today is get through these spreadsheets. So hopefully everybody's got their 2 spreadsheets for paper 7. The one issue we had was that people who came on Tuesday, we forgot to run the solver. I fixed several of them. What you might want to do if you're at all uncertain on either of the files for paper 7, send me your file and I can look at it real quickly and just make sure there's not any issues. So it was kind of chaotic Monday and Tuesday. Thursday went a lot better because we had the video, and you've got the video. You could come and do it yourself as well, because the video walks you through everything, and it's good to know how to do these files. Bloomberg's powerful. It was working on over half the machines. So this is the first file. So let's talk through this file. So you got the data. One thing you have to be careful of is, and let me just warn you, on this second page with the values, you notice it goes down to 11,923. That's probably what you want, or depending on what day you did. If you go to the output, though, you need to go down to the bottom of the output. If you do end down, it may go further than that. because there might be a bunch of blank cells down here. I mean, the formula is there, but the formula gives it a blank. But make sure your bottom line is at 11,923. If it's not, you'll need to go across and copy that bottom row down until you get the 11,9. I found what I did is I like to delete the rows I don't need, so it's just like there's just a bunch of spaces. So when you go down, it goes down to nowhere, and you have to go find the bottom of that, and then just delete all of that. Unfortunately, I did that in this file, but I did it with the firm that didn't have as much data as others. So if your firm has more data, then there's a good chance. So you look at this file, make sure your very last row is the same as the very last row in the pace values. All right. Now, if you go below that, I would go to the next row where the blanks, you'll notice there's like a formula in here. It just says, if that equals 9, give me 9. Otherwise, just give me space. So it looks like that. There's stuff there, but it doesn't look like it's there. And so if you come down the bottom and there's still stuff there, I'd recommend you do Control-Shift down and just get rid of all of that. And the reason for that is when you do graphs, you want to be able to do Control down so you can highlight that whole range. But if it keeps going down another 50 rows, you're going to be irritated. All right. All right. Anybody see a problem with their file?
Mine was after 11/7.
Yeah, if you went, that's probably Monday, right? So if you came on Monday, yeah, that's fine. 11/7 is fine. I mean, if you want to update it, you can go back and update it. But yeah, and then is the row after 11/7, is it blank? Is there a formula in there? All right, so yours was done correctly. Did I pull your data, or was that you did? I can't remember. You did it. So it may have just worked out because you had similar data to Walmart, or whatever company you had in there. All right, so how are you going to handle this? Well, the first thing you're going to decide which ratio you want. So I have PE ratio. For Walmart, I'm probably going to use EV to sales, price to book, and the one that's the most challenging is EV to EBITDA. That's where you're going to find some places where you don't have data everywhere. So if you're going to use EV to EBITDA, you'll have to start your graph wherever the data starts, because it won't be. I'm sorry, it's probably a spam call. Let me put it on airplane mode. I used to get 0 spam calls a week. Now I'm getting like 5 a day. So it's getting kind of irritating. I don't know how they discovered me. I must have clicked on some web page somewhere, and now I'm the most popular person on the spam. All right. So EV to EBITDA is a little challenging. One thing you'll notice on EV to EBITDA is that there's obviously problems with it in certain years, because you'll see it's like the same number over and over and over and over again. And so what that means is they have daily numbers today, but they used to only have weekly numbers or monthly numbers. And so you'll see the same week has the same number over and over again. You can still use it. It just gives you kind of wacky looking charts. So if you can get away with not using EBITDA, if you instead use PE ratio, that's better. When you have PE ratios, the other issue you have is some extreme numbers. I don't think Walmart does, but sometimes a firm will report like really, really low earnings, like 2 cents, and their PE ratio is like 40,000. In that case, what I recommend you do is you take those years, you take those days out, just to completely take them out of the analysis entirely. You have to kind of decide where those are. So some are going to have that. With F&D, you don't have a lot of history, so you're kind of stuck with what you have, and try your best. They probably do have some weeks or years where they had some really, really high numbers. Now it's going to be for an entire quarter. So if they report, or for maybe, depends on how long the strange earnings was there. So, but it'd be at least a quarter, because you can have at least one quarter, earnings are released every quarter. So the earnings can't change throughout the quarter. So it's going to be, if you have one bad one, it's going to go for 30, 20 something days at least, and maybe a full year. All right. So you do have some data issues, but what do we do with this data? So let me start with PE ratio, Walmart. So what this number is, make sure you get this in your notes. What this number is Walmart's PE ratio divided by their industry, Walmart's PE ratio divided by the S&P 500. All right. So the way you write this, you see that Walmart is 105 versus the industry and 109 versus the S&P. So the way you write this, it's real simple. This is like one of the easiest things. So Walmart is currently trading 33% rich to consumer staple stocks and 35% rich to the S&P 500. You'll see where I got those numbers. How did I get 33%? They're trading 1.33 times higher than their industry. Now that may be fine. If it's NVIDIA, you expect them to. But this is Walmart. This is much higher, 27% and 23.5% than their historical relatives. Right? You'll see where I get these numbers. Walmart's currently trading 33% rich. That's the current number. And 35% rich to the S&P. This is much higher. I know how to spell higher. Much higher, 27% and 23.5%. Or what's another word I could use besides higher? You want to be fancier, much richer, 27%, 23% than historical relatives. Okay, that's all you got to do in this part of the paper is you talk that and you do a graph. So how do you do a graph? Well, you might be able to just do the graph that's there. You have to see what it looks like. Okay, well, I can't get over there. There's this thing right here. You have to look at the graph and then you're going to kind of pick and choose. This one worked pretty well. But if you have one that's like 40,000, it's not going to work. It's going to be off the chart. So this one, Walmart worked pretty well. You notice they used to be much richer when they were a smaller company, but the last several years, they've been more right at or below 1, and now they're at 33. Right, now if you look at some of the example papers, you could do a chart. So there's one chart you could do. You gotta identify everything, right? You gotta put the dates in there, which is really easy to do. You got to put the legend in there. And when you do the legend, just make sure all you need is years. You don't need all that extra stuff. So this can work. Another chart you could do is to do Walmart to Staples with the median for that time. And then do a second chart, Walmart to S&P 500 with the median for that. And then you have to just set that up. So you can modify this, add columns or whatever you need to get the graphs that you need. So if you look at example papers, I don't know if I saved an example paper or not, but if you look at an example paper, I always like to use Costco because he followed the examples just really precisely. So he just did it without the median, but he could have added the median in there. But he did a chart versus Staples, and he did get a chart versus the S&P. He did EV to sales. Here he put them together in one chart. So that's all we're talking about. And then he just has the exact same thing. Costco currently trading 90% rich to the S&P 500, but historically it traded 31% rich. So they're currently 59% rich through history. Real simple stuff. All right. And you can somewhat see it in the chart. So others add the median or something in there so you can kind of see it. Now, why he did two charts on PE ratios and one chart on EV to sales, that I'm not so sure about. Now, why do companies trade rich? Remember, there's two reasons. Three reasons. One, they're overpriced. Or number two, they're fast growing. Or number three, they're low risk. Costco has been fast growing. They're also low risk. So it kind of makes sense that they're expensive, but this is versus their history. Those kind of things are true historically too, except for the overpriced. So if they're fast growing and they're low risk, they were probably that way 10 years ago. So that probably hasn't, unless they suddenly started growing faster or they suddenly become less risky. So that history is important. If the history radically changed, like with Walmart, used to be a small company, now it's a big company, you can kind of take that into consideration. Now, Costco and Walmart should trade cheap on EV to sales because their sales are massive, but the margins are thin. So firms with thin margins should look cheap on EV. This is one of the reasons I don't like Costco, because they look rich on the EV to sales basis, and the firm as thin as their margins are, that doesn't make sense to me. All right. So it's pretty easy to do. You can, in a few seconds, put a title up there. Walmart relative PE, make sure it's the relative PE. Don't say Walmart PE ratio. You have to say relative. It's their relative PE ratio to industry and market, something like that. So this is not a chart. We make it really clear. This is not a chart of their PE ratio. This is a chart of their PE ratio relative to their industry and to the market. And you can kind of tell looking at the chart, the way the two lines line up, that this industry stays pretty consistently at the same level of the S&P. It's Walmart that's flying around. So the industry itself stays at a pretty constant area. So I recommend you do at least two of them. I've had some students do all four of them. I mean, you can, that's a little overkill. I would never do a price to book on a tech company. It just looks strange. People are like, why would you do that? Price to book doesn't, unless maybe I was doing Intel or somebody has a lot of property equipment, but price to book, for Deere would make sense. PE ratio always makes sense. If you got good data. If you don't have good data, EV to EBITDA can make sense. EV to EBITDA works really well for tech companies. EV to sales makes sense for most of y'all's companies because you've got a lot of firms in here that are somewhat retail exposed. All right, so let's look at EV to sales. So they trade cheap EV to sales, but you expect them to. So Walmart is currently trading what? To their industry. Trading, someone throw it out. Y'all got to do better in my previous class. And they were, right? It's like they were asleep or confused or what. I mean, Jay knew all the answers, but I couldn't get him to talk because everybody's just too late. Everybody's like exhausted. We're talking about life and death and they don't want to talk. So, but y'all got to do better. Walmart is trading what currently to Staples? 52% cheap to Staples. And what about the S&P? 72% cheap. S&P 500. However, historically, they have traded even cheaper. 50, I mean, yeah, even cheap, yeah, even cheaper. No, that backwards. Power doesn't work there. Historically, they have traded 50% and 64% cheap staples market. Relative is 6% and 22.6% rich to their history, something like that. You can probably word it better than that. They're not that out of line on staples on EV to sales. They're much more out of line to the S&P 500. Walmart's done pretty well, so that's probably part of it. I think you're going to find if we had Costco, we haven't given your Costco numbers. My guess is Costco looks even more overpriced EV to sales because they just have really had a run. If you're doing restaurant stocks, I haven't looked at them recently, but they've had such a roar this year. There's a good chance. Oh, Mohammed, you're doing Chipotle, right? Okay, who's doing Geronimo? All right, so Geronimo, I would think you're doing Costco, right? Yeah. Yeah, I would guess you have your. I don't know if you ever follow up. I would guess they're even further off than Walmart on EV to sales because they just have traded really rich. Um, and again, you can graph it if you want to add the median here. You just put the median in there. Um, so they're essentially in line on their to their industry. They're slightly expensive. It doesn't look like they're expensive here. Oh, they're cheap. Oh, I'm sorry. Did I mess y'all? How many are sitting there going? That's why y'all aren't talking because I kept making mistakes. So there is 6% cheap and stable. Sorry about that. And 22% rich to the market versus history. Sorry about that. I didn't see that negative. So they are actually trading slightly cheap, but not much. 47 versus 57, they're essentially in line. So yeah, sorry about that. Now, do you have to go into a big dissertation why they look rich on PE, but they look in line on EV to sales? Maybe if you can think of some reason why that's the case, it really comes down to margins. And if their margins change dramatically or not, we know their margins are somewhat down, but so is the industry. So it's hard to say. The other strange thing about this, especially with the Walmart, is we know growth stocks have really taken off. So you would think, now we don't have growth stocks in the staples, but we do have growth stocks in the S&P. You would think anything that's not a tech growth stock, like Meta or Amazon or whoever, you would think they would look cheaper versus history because growth stocks have done so well. So it's almost a worst case scenario here for Walmart than these charts show. But at least they're in line on one of the charts. So do at least two of them, PE ratio and price to book or EV to sales. Do at least two of them. And if you can't get one of them work, and just to give you an example here, I don't know if I can do this or not, but not there, sorry. Oh man, I Really do hate this thing. Okay, let me go back further. So if you have something like this, so what do you do in that case? I must have missed one here. So obviously you can't turn that in. So what do? You go find those few ones, and you can actually do that. You have to decide where. You can actually just go in, highlight them, and just hit delete. You can hardly even tell it's missing, right? So you got to decide where it starts and where it stops. So you got to make sure it doesn't distort your graph. So you can't make it. It can't just look a straight line on the base. So I don't know how high Walmart could go that would still make sense. All right. Any questions on that? This is kind of one of the easiest parts of the paper because I just want to make sure you know what a relative means. In an interview, you say, yeah, man, it's NVIDIA is really, it's not only trading rich to tech stocks, but it's really rich to its history. You just want that to flow very naturally. It's kind of an obvious thing to say. Um, how do y'all's charts look? Anyone have something that's just a mess? I'm sorry, what?
It might end on November 7th.
Yeah, 7th is okay. If you came in on Monday, yeah. I mean, if you want to update it, you can, but it doesn't. I mean, a day like today almost makes you want to update everybody because it's a big day, but you don't need to. It's you got to stop your paper at some point, right? I have students I like, I turn in paper 2, I want to edit it. Do I need to update or paper 3? It's like, no, just stick with what you had and don't because they released earnings, so I got to redo papers 3. Like, no, don't do that. So yeah, you're writing a paper over a semester that you'd normally write in a week. So in a week, things don't change like this, but in a semester, yeah, things can change. I've even think I had one company that got bought out during the semester. It's like, what do you do there? And it's just crazy. So, all right, other questions on this? Anybody see your chart, do anything wild? So if you have something coming up that's a problem, let me know. Send me your file. Now, if you want to get more sophisticated, go add other stuff. You could definitely. I could put Walmart and Costco on the graph and just show the two of them. Or if I were doing Home Depot, do Home Depot and Lowe's. That could be interesting. You'd have to go back and run this file and bring it in. So you could do that. So there are ways you can add more to it, but I'm really not asking for that. It's really basic. Just comments like that. Rich to the industry, rich to the history. Cheap or rich to the industry, to the market, to their history. All right, so that one's fairly straightforward. Put a couple of charts in there, essentially just like he did in here. If you look at some of the others, they'll be a little different in what they show, but they're all using the exact same spreadsheet. All right, so the last thing you want to do is a football chart. And I know for some reason I left somebody else's names out in my email or last week. I don't know why. I thought I copied and pasted them. So it wasn't like a slight. It wasn't like I didn't want you to come. I just somehow messed up. All right. So what you're going to do on paper 7. So paper 6, you did maybe DDM, cap earnings, H model. I'm going to go back to that file and show you how you can do relatives. You might do the cap IQ model. So maybe you have 5 or 6 models that you have in there. All right. So what you do to do the football chart is you put your minimum value, you put your maximum value. Your actual target's not in there. So you type those in, and then you put the difference. You just do a formula for the difference, your max versus your min. And then what you're going to do is you're going to highlight those and insert a sideways bar chart, not the 100% one, but the one that doesn't add up to 100%. All right. You want stacked sideways, not that one, the 2D bar, but the one in the middle. All right. I got that. Then what you do is you select one of the first bar and you right click and you make the fill no fill. You make the outline no outline. So that disappears. Then you select the outside one, do the same thing, get rid of no fill, no outline. So that takes care of that. Then what you want to do on these is you want to add a data label. The same thing over here, add a data label. And then the last thing we want to do is change this range. So let's go to say 200. You don't want to quite so wild. Go to 200. And then you're going to have to just manually move these guys over, which can be real irritating because if you're not right in the exact spot, it won't move. And you have to get that guy, right? This is so irritating. You have to get that cross. Any other symbol doesn't work. The arrow doesn't work. So you got to find right where it is. There it is. Sometimes it's like really finicky. Move that over. Same thing with these guys over here. If I were you, I'd probably move this in the PowerPoint so I could do some other editing with text and certain things. So you want to have the title of the charts in there so you can say which one's this, dividend discount model. And this is the range, your low and your high. If you don't like the colors, you can, definitely change the colors. All right. So what else would you want in there? Well, the one other thing you want is the current price. And I don't know how to do that as a line. So you can probably do shapes. Let's say the current price is, I don't know, $75 or something. You can put the current price in there and mark it. So it's the current price. So this looks like a pretty good stock, right? Because it's trading down here and we have all this upside. There's only a little bit of downside in one of the models. All right, so that's how you do it. You don't want anything on the legend. Oops, what did I do? You don't want anything on the legend. You won't let me do the legend. On that legend, I just wanted to hide the legend and it won't do that. Yeah, so don't want the legend, but that's what you want in there. Now, if you change this, I had some problem formatting this because I kind of would like it to go to 150, but when I did that, it really messed it up. So, you have to be careful. Make sure you have it perfect the way you want it before you do that. So you have to play around with it a little bit. You really need to get a football chart in there. I can't remember what titles they put in there. I don't think they call it football chart. I think maybe it's model comparisons or something. But this becomes so common, very, very popular. I see it all the time. I think the last 5 years, it's really, really just become the norm. The CFA Research Challenge, you see it a lot in there. So, fancy it up, make it look pretty good. Instead of this 1, 2, 3, 4, that's where you want to put your title of what you're doing. So you may have to manually, y'all probably know this better than I do. So insert a text box, and I don't see, there it is. So you could, yeah, I didn't do a good job on that. But you can put the text box over there. So I'm much better in PowerPoint doing stuff like this. I'd probably take this graph, put it in Power. I might even actually build this chart in PowerPoint because everything I just did, you can do in PowerPoint as well, and do the whole thing there and then copy it over into the paper. Any suggestions on how to get this to work better? Makes sense?
One more time, what is the blue line percent, the vertical line?
Yeah, the current price. Now I've seen some, I don't really care for this, but I've seen some will put one for the 52-week range, kind of at the bottom. And I don't hate it, but it's kind of strange to me because that's not a valuation. But some people like that because they want to show that I show all this upside, and oh, by the way, 9 months ago it was trading there. So you say, like with Facebook, you can say, wow, it's like when Facebook hit $90, it's like not only is it trading really, really cheap versus my models, but it was up to where my models showed just 9 months ago, and now it's down to $90. It was $350, now it's $90. So you might add the 52-week if you want to. That may make some sense. It kind of depends on your stock. It may or may not make sense, depending on what's going on. There are people who think you think it's worth 350 and it traded at 350 not too long ago. I can kind of see that's possible. Versus it's trading at $90 and its all-time high is $92 and you think it's worth 300. That, wow, you're really, really optimistic. So anything that adds a little more insight on it. Other questions on this?
How did you bring in the blue line again?
I just clicked on the chart and just did insert, and over here it says shapes, and a line is one of those shapes.
Oh,
I do the same thing on the when y'all did the chart for the other file where you had the all the dots and the ranking. I don't do a trend line. I actually draw that line by hand, so it hits the two corners. So you don't want, but so yeah, I just manually. But if I were doing this in PowerPoint, it'd be a lot easier to manipulate these things around. There's different ways. I've seen it so many different ways. So current stock price, I like that. They have it in there. Here they have the titles over here. It makes some sense. Most of them that I've seen go to 0. I doubt you'd want to start it at 100. So they use dollar signs. You could certainly do that if you wanted to. Do you want pennies in there? I don't know. That seems a little overkill to me, but you can't. I mean, you decide what you want it to look like. But so here they do have the 52-week in here. So you can see the stock's trading at the upper end of its 52-week. There is some pretty good upside. There's a little bit of downside here, not on a 52-week, but there's a little bit of downside on these two models. So they got a DCF model, whatever, the proprietary growth model, each one of those things. Here's one that you can't see because it's way too small. Yield, DCF. I don't know what expected price means. That's kind of strange. Yeah, they're not going to let me do that. Expected price. Yeah, that makes no sense. I have no earthly idea. Some of them do go the other direction, but 90% of them are going sideways. So I'd recommend you do that. It's just the more normal. All right, so for DDM, what you're probably going to do there is you're probably You're gonna vary beta and growth. So you have a best case. Your best case is your lowest beta, highest growth. Your worst case is your highest beta, lowest growth. Cap earnings, if you do that one, you're going to change beta and inflation. Probably going to be much tighter because your inflation is not going to vary quite as much. H model, you have to decide what you're going to vary there. That one gets a little trickier. You might be multiple. So you might say, okay, I have one high growth with this H and this long-term growth and this beta. You got to be careful when the H model that you don't get too wild that it becomes such a massive range. That it just goes off the chart, you know. It just dominates so much. But you can run more scenarios with the H. But you have to combine them. So your short term, your H, your long term, and your beta that gives you the highest value. So you're doing the best of each one of those, which just means you can get really way out there. And in your worst case, in each one of those, you can get way over to the side. Maybe you don't vary everything. Maybe your H doesn't change. Maybe you only change the short term or long term growth. But you know, find some way to put that in there. All right, let me show you on relatives. So if I'm going to use EV to cells, what I want to know is some percentiles. So I might equal percentile, say comma 0.2. So 0.41. My median is 0.5, 0.41, and then I might do my 0.8. That's 0.72. So I'm currently at 0.72. So essentially what I'm going to do is say, what would the price be if I were at the 80th percentile? What would the price be if I was at the 20th percentile? And you just adjust the price so that it would be right at those historical levels. Okay, really, really straightforward. So if the current price, what is the current price? Current price 167.65. So my lower end would be this times. Oh, wait, this 0.72 is against the industry. Sorry, I said that wrong. Be that times that divided by that. So there's my lower end. The upper end is that times that divided by that. So there would be my range, 147 to 258. So you just take the current price times the 20th percentile divided by the current, or take the current price times the 80th percentile divided by the current. Just make sure I was comparing to 72 the wrong thing. You were doing both of these to that. So that on the relatives, that gives you something that could give you two relatives, right? Because you could do PE ratio and EV to cells. You could do both of them. And that gives you more options in there. Everybody see that? What I did? Current price, you just adjust it for where they are historically versus where they are now. And the capital IQ model, we talked about that one. See if I can find it. Someone did something this computer and everything's really, really small. Boy, I got a lot of files because I did so many files for y'all on my machine. All right, y'all remember this one? So I want y'all to use this one versus what I've used historically. So just pull up this file. If you're having trouble finding it, I put it out there on Canvas. You'll need to be on the Capital IQ machine to be able to run it. So if you're not sure how to do that, set up time with me and I'll walk you through how to do that. We'll get the data on the one machine that in there that's actually working. If it's working at home for you, then you can do that. So how do you do that? Again, run 3 scenarios: a base case, best case, and worst case. Change your beta, change your growth rates, and just see what you get. All right. So pretty straightforward. Get your base case set up first so that you have the right risk-free rate, the right beta, those kind of things. So make sure those are all set up correctly. But once you get that set up, you get the valuation, get your base case, and then go in and change some factors to get the range. So that should get you a pretty good list. Probably 6 or 7 altogether. All right, everybody's got it. That goes at the end of your paper 7. So you talk about the relatives first. You talk about your ranking models second. Then you do the Capital IQ model. And then you bring paper 6 and 7 all together with the football chart and you're done. So this paper is not that difficult for most people to write. It's actually pretty straightforward. You've got all the Excel that you need. You just got to write about it. Pretty straightforward. Any questions on that?
On sheet 1, on the relative file, looks like you combine all of them.
Yeah, that's the old way. So I don't want you to do that anymore. I want y'all to do the Capital IQ file instead. This is essentially the Capital IQ, but just not as sophisticated. I'd rather use Capital IQ because they set it up as much like an investment banker they could. And I overly simplified it here. This is much simpler, but since Capital IQ already set it up for you, it's really not that complex. You just got to change the assumptions. So I'd rather do something more sophisticated looking than this. I was trying to make it simple for you, but Capital IQ's done the work for us. But this really is the exact same thing they do. It's just it's fancy. Other questions? We're getting close to the end. How are your paper 5 and 6 going? I'm getting there. I've seen some pretty good drafts. So if you got a job on an analyst job, I've had some students get a job and they just did exactly what they did in this class and they were perfectly fine. Now they had to have Bloomberg, but most of them did have access to Bloomberg. Most of them didn't have access to Capital IQ on the stock side. The Capital IQ is in other industries. Victory Capital does use Capital IQ, so you're starting to see in some places. I don't know how much it costs relative to Bloomberg. It'd be interesting to see how those two are competing. It's good to see someone's competing with Bloomberg. So you have to see what your firm has, but if you just exactly do what we did in this class, you'd be in great shape. So what's the one thing you might not do is this last paper that we have, which is the technical analysis. So let's start it. I'll let you out a little early, but let's at least start it. Technical analysis. Most people, when they think technical analysis, they think, oh, that's what you do when you think markets are inefficient. And that was kind of my thought process as well. But Dr. Dalquist used to teach here. She wrote a really interesting book. She and another person, so I don't know how much she wrote versus the other guy. But their introductory chapter is really good. The rest of the book is really tough to get through. It's just so much just detail. But she actually argues technical analysis assumes markets are very efficient. The exact opposite. So how can she argue that? And essentially what she's saying is markets are very good at handling fundamental data. The problem is it doesn't hit supply and demand at the same time in the same force. So what technical analysis is telling you is the fundamentals hitting the market but the supply and demand is out of balance, and technicals are telling you it's out of balance. They're very efficient. Everybody gets the information is really efficient. They're really fast, but there's 20 of these and 50 of these. And until they get back in balance, technical analysis is telling you that. So that might seem like an inefficiency, but essentially it's just saying there was a bunch of players and we don't always know who's where and what they're doing, who has the most money, who's investing, who's moving the fastest. So there's just these imbalances, and technical analysis is helping you bet on those imbalances. So we're using past data on a stock or index. We might use volumes as well to try to figure out a buy or sell decision. It ignores fundamentals. We're not trying to ask, does the stock make sense or not? We're ignoring price relatives. We're only looking at the price history. Now, the best firms out there, my favorite is Davis Research. NDR. Now, NDR costs a fortune, so I wouldn't recommend you get an NDR account. They say register for a trial, so if you want to really go a while, you can register for a trial. Just make sure you cancel in time because you don't want them charging you $2,000 by accident. I had one student do that, not with this, but do it, and they charged her, and she was like all in tears, and she called them and they reversed it. You know, she did the college student in tears thing and they reversed it. But so I don't know how much it costs. You can try it. We use Ned Davis at my firm at UTSA, and I was never a technical guy, but boy, I was like, this is really good stuff. But reason I mentioned Ned Davis, I'm not a Twitter user or X, whatever they are. But supposedly Ned Davis has a lot of free stuff on X. So if you're on, how many of y'all use X or Twitter? Are y'all in there? So if you're, yeah, y'all might search for Ned Davis. They don't provide everything for free, but they provide a lot of stuff. So it's like they're trying to get people addicted to their site. So they give enough stuff out there that's useful and valuable, but not everything. So you might try that. The guy whose place I took when he retired, he was a huge Ned Davis user. They let him keep his account for free after he retired. And then they took it away. And so he was like in tears. I think he decided to pay for it. I don't know how much it was for him. They gave him kind of a deal on it. They finally made him pay, but not the full fare. But he loved Ned Davis. So what they do is, first of all, their database is just incredible. So if you had a question of how do small cap growth stocks do when the Fed's tightening, they'll do that and send you the chart. And if you like it, you can make it permanent, and they get back to you the same day. It's just really amazing. They'll send you the data. I wish I could show you some of their charts. I don't know how many of them they show in here of example research. They probably have some that they show you. Now, Ned Davis, I don't think he's there now. So he sold his firm. And my understanding of the history was he sold the firm and he came in as an analyst. So he still wanted to work. So he came in and sat at a desk and was working like just one of the analysts. So pretty cool guy. He's supposedly a little eccentric, but he's built quite an empire. So what they do is they send you a technical analysis. So you ask the question, what happens with inflation? What happens to small cap when large cap's doing well? What happens in recession? Any question you have, they run the analysis, and you say, I want this indicator. I want to see how this indicator does. They send you the analysis. They say the indicator works 62.3% of the time. And here's when it's worked. They send you the charts. If you like it, you make it a permanent part. They don't charge any more for that. It just becomes a report that you get every month or every week, whatever you want. It's just really, really pretty amazing. So unfortunately, I'm not showing you stuff here. I could probably find NDR charts on images. And yeah, here's some of their charts. So this is the kind of stuff that they do. And they'll give you I really think it's great when they show you what percentage of the time it works. I remember the most amazing thing to me was February of 2009. They had, I forget how many, somewhere around 10 charts that call the bottom of the market. And they call me and go, hey, I don't know if you're watching this, but we've never in the history of Ned Davis seen all 10 of those charts say buy. And right now, all 10 of them say buy. Our charts are saying this is the bottom of the market. And when did they say that? At the bottom of the market. It was absolutely perfect. So that they're not good at calling the tops of markets, but they're much better at calling the bottom. But those 10 charts we're at the bottom, you should be buying stocks. And so we were buying stocks. So yeah, it was pretty amazing stuff. And you're buying stocks when the articles are saying this is the end of the world, market's going lower. That's how you know it's the end of the market. That's when all the newspapers are saying it's going lower because they get it worse. They're at the end. So this Ned Davis stuff supposedly is on Twitter, and who knows what they're reporting on. But if you're interviewing for jobs, having a Ned Davis chart to talk about in an interview would be pretty sophisticated thing to do. But I don't know how much they charge. It's probably not what college students would do. But if any of y'all have the guts to click on that, any of y'all want to try it? Any of you have the guts to click on that and see what it asks you to do? You have to give them your firstborn or whatever. It'd be interesting to know. So they ask for information. I don't know when they tell you because you're probably gonna have to give them a credit card. And at that point, hopefully they're gonna tell you if you don't do anything in the next 14 days, 30 days, I have no earthly idea. We're gonna charge you a few $1,000s. So if anyone has the guts to do that, let me know. Maybe I'll do it. Who knows? And try it. Very, very good firm. So if you're working in a firm and they're asking you what extra research you need, you might, explore Ned Davis a little bit and just see the advantage you have. You're working for a firm that say has maybe $200, $300 million in assets under management. This may be the great opportunity for you to call Ned Davis and say, hey, I heard your service is really good. Is there any way I can test it for a while? They may give you more time or give you more charts, let you experiment with stuff. So you could show your boss. This is the kind of stuff you do where you get really good early points in a first job. So yeah, I saw this thing that I thought was really, really good. So anyway, so there are some of the best in there. Another one, I'll have to find this, but there's a podcast. The lady's name is Kathy. I can't remember her last name. Really, really good podcast. I'd have to look for it again. I think it's was on I forget the guy's name, not Shaughnessy, but the other one. But she came on to talk about technical trading. That's all her firm does. It's technical analysis, and they sell it. And she made a really strong case for technical analysis and how it works. It's really, really interesting. She's, I say older, she's a few years older than I am, which means not only was she one of the early ones in this market, she was like the first woman in this technical analysis. So she's kind of famous for being really a frontier person in this market. So she has a very, very long history. It's all she's done her entire career. So there are places you can go to really learn this. There are some books out there. Most of the books are really tedious to get through. The one book I do recommend is Andrew Lowe's book. I don't see it in here, but Dr. Lowe, here it is, The Evolution of Technical Analysis. This book doesn't tell you how to do it. What this book does is it gives you the argument for why you should do it. So he's giving you the theoretical basis. So he believes in it. He goes back historically. He goes back quite a ways, back to like the Roman Empire, when people were getting on horses and running with price information to the city 100 miles away. Whoever got there first on their horse. So he goes back, but he makes the argument, and he's a very impressive person, right? MIT, very respected. So he gives you the argument. So if you're going to do technical analysis, you need to have a good fundamental basis for why you think it works. And he makes that argument. And again, it's just a supply demand and balance type of argument is what he's making, but he makes it much more sophisticated. Pretty inexpensive book, $18 or whatever, you can get it on Kindle. So you don't have to do that in your paper. You just assume it works and you're going to talk about it. All right. So what we'll do, I'll let you out a little bit early, but what we'll do next time is we'll talk about the type of technical analysis that you would need, the basis for it. We'll talk about the weak form test, what history shows, but then we're going to talk about what you need to do. For paper 8, I'll make it really simple. You have to do moving averages. You don't have to necessarily do simple moving averages. You can do some exponential smoothing moving averages, but you need at least one moving average in there. What's the other word for moving averages? Anybody know? It also starts with an M. Momentum. Have y'all heard momentum? So we're looking to see if your stock has momentum. That's the moving average. And then you have to pick 2 others. This is the paper. You could sit down at the Bloomberg machine, type the word tech, bring your stock up. You could write your entire paper in just a couple of hours, 2 or 3 hours, just sitting there at the Bloomberg machine, the entire thing. It's not a long paper. Some of them are only 2, 3, 4 pages long. It's the paper I grade the easiest. So this is like the give me points on the technical analysis. All right. So I just want you to be exposed to it. Most students will do, you have to do moving averages. A lot of students do the Bollinger Bands, which is essentially a moving average, but with standard deviation bands around it. So real simple. There's a few other students like to do. I recommend you do moving averages, Bollinger Bands, and find a really exotic one with a wild name. Some of them I can't even pronounce the name. Just so if you get into an interview, you can talk about, yeah, I saw this one thing, it looked pretty interesting. Just, something. So a lot of people like to do the Equal Gumi. I can't pronounce it, but that one, just because it sounds really wild. It doesn't look that radically different than the Bollinger Band. A lot of them are that moving averages with a standard deviation band around it. So it's really simple stuff. It sounds really sophisticated. It looks really sophisticated. If you're interviewing with the human resources people, they're going to think you're a genius because it just sounds really sophisticated. But it's not all that. You're just taking a standard deviation of the stock price and putting that around the band to see if it's getting out of whack. So real simple stuff. And we'll talk about this more. So I'll let you out a little bit early here. Any questions on anything? Papers 5 and 6 aren't due until I think next week sometime, right? So I think it's the day after Thanksgiving. You can, if you're late, not a big issue. I did put it already out there so you can submit it. If you want to meet with me by Zoom, this weekend's pretty good. I don't have much to grade this weekend, so this is a good weekend to do. So, all right, we'll stop it there. So I finally found a book I was talking about. The reason I couldn't find it is I always forget her name has an H in it. It's Dahlquist, Julie Dahlquist. I didn't make it through the book, but the first few chapters are really, really quite good. It's a fairly inexpensive book, so I don't think it's being used as a textbook. She did teach, y'all probably don't know her because that's her picture. She's at TCU right now. I thought her husband taught at St. Mary's, but I don't know, maybe he moved. But she was at UTSA 2004, 2015. So well before your time, 8 years ago. It's hard to believe it's been that long. But so she taught one semester. We had students begging for a technical analysis class, and it's the only semester there's a technical analysis class in our program, but it's just never taught. And I don't know how the class went. She taught it in the Bloomberg room. So I don't know if that's something that would be of interest. It's a tough class to teach because it's just there's so many different ways you could tackle it. I need to find that lady on the podcast. I'll have to look for that. That one, it's been several years on that one too, but it's a really good podcast. But this book, what makes it so tough is just how in depth it goes every chapter after chapter. There's a lot of numbers, so you kind of get overwhelmed. So it's not a good book. I like to read while I'm riding my bike, listening to Audible. This is not an Audible book. It's just not that kind of book. But the first 3 or 4 chapters would actually work pretty well. So let's talk technical analysis. So technical analysis was supposedly tested by by Eugene Fama in the 70s as a contradiction to the efficient market hypothesis. And this was his weak form test. And he asked the question, can you beat the market if the only information you have is historical prices? And according to him, he said it was a waste of time. And how he tested that is a little interesting, but how do you actually test if it works or not if you don't know how everybody's doing it? So the lady on the podcast, I think her name was Kathy, she talked about in the 70s before computers, they had these big boards. They're drawing prices on graphs on the wall. And that's how they're doing their technical analysis. And it's pretty amazing with calculators, getting moving averages and all that kind of thing. And they went from that into computers. Do you think AI is doing this stuff now? And this is like perfect for AI. You can just have it look at every single possible price movement and figure out something that works. So it's probably getting out of the hands of the practitioners and getting in the computers. But he said it was a waste of time. If you read Dr. Lowe's book and Dalquist's book, they both make an argument that there is a good, strong theoretical statistical argument to be made for technical analysis. We used it at USAA. I'll show you how we did it at USAA. The way we did it, I didn't much care for that approach, but there were some other ways we did. And then I showed you David's research. I think that's really valuable. What he does, what his firm does is really quite valuable. According to her book, the 92 studies that were shown, 58 showed positive results, 24 showed negative results. So there is studies out there since Eugene Fama showing that it does work, it is effective. Dalquist's book is frustrating in that she doesn't give you anything that works. Everything she shows you used to work, but doesn't work anymore. So that's part of the problem with technical analysis. Once it's discovered, everybody uses it and then it disappears. So technical analysis assumes markets are informationally efficient, that we're really good at looking at information, making decisions about value, and making trades. And so like technical analysis, this is coming from Dalquist's book, is they assume information is priced in. So the only thing you don't know is the supply demand for the stock and how that balances. That's the only thing you don't know, but that's going to work itself out over time. So this information efficiency, the process works itself out over time, but that's uncertain. And what fundamental analysis does is it gives you that immediate impact depending on the supply or demand, that we're really good at processing information. But essentially technical analysis says fundamental analysis is too good. You're not going to beat the market doing that because they do that immediately. The people looking at that are really good. They're going to beat you. What fundamental analysis doesn't help you with is those supply demand imbalances. And technical analysis is saying that's the only thing we're not sure about. And that price behavior can tell you that pattern. So the art of technical analysis, I don't know if I think these are all coming from is this an actual, I didn't realize let's see if this is her book. That'd be kind of funny. I've been looking for it and then there it is right in my notes. Yeah, there it is. Sure enough. I should have looked at my own notes. So the art of technical analysis is identify the trend changes at the early stage and to maintain in position until the weight of the evidence tells you that the trend, essentially what you're doing is you're waiting the trend until supply and demand comes in balance. Once it goes into balance, then you get out of that trade. The word trend is underlined and bold because that's the key. These are trends. We're looking for a trend that is predictable and you can tell when it ends. If it's not predictable, it's not a trend. So a trend has a pattern that's going to continue until some point in time. Technical analysis represents a rational choice for bounded rational investors. Bounded how? You're bounded in that you're making the same, you have the same information everybody else has, you're doing the same type of analysis, you can't move fast enough, you're somewhat just limited in what you can do because you're competing against a lot of really smart people who have the same stuff you do. It can allow them to make reasonable, well-informed decisions with relatively small information processing costs. Whereas fundamental analysts, they have to have all these analysts, they have to have all this information, all these models. Technical analysts, all you need is the price, and you can make a decision. So I used to show this guy Frank, and I can't say his last name. How would you say that? Teixeira? A lot of extra letters in there. I don't know where he is now, but he's not at that fund anymore. CMT, that is CMT. There are now, you can get certified as a CMT, which is Chartered Market Technician. So they actually have charters. The CFA has been adding a lot of new charters. That's not the one I would recommend. If you want one on your resume, the one I think is the most powerful is the chartered modeling one that they have, which is really, really powerful. But I think you'd be a little too precise to get that one until you're sure you want to be a technical analyst. So I'd kind of wait on that. But he came in and spoke at UTSA. I thought he was impressive. He made some really good, strong arguments, but his fund is now debunked because it did so horribly badly. So it didn't work for him. But smart guy, real personal guy, a lot of fun to listen to, very animated, very into it. If I can find that podcast, I thought she was even more impressive. So I don't know if I can find a picture. I don't know if I even recognize this picture. It's been so many years since I've seen him. No telling where he is now. Yeah, he's at Wellington Management. That's the fund that no longer exists because its performance was just so bad. He's done some impressive stuff. So I'm not going to say that it underperformed because he wasn't good. It's just tough. This is a tough way to make money in the markets. All right, so technical analysis. You're looking for trends that reflect human emotion and behavior that's somewhat predictable. Again, it's driven by supply and demand. Technical analysis says your goal is not to understand these forces. You can't possibly understand them. There's just too many players. There's too many things going on. There's an infinite number of explanations. So technical analysis says ignore the why and just accept that prices provide information on supply and demand. Supply and demand is driven by fear and greed. This is something that Dr. Lowe talks a lot about, fear and greed. Sometimes markets are overwhelmed by fear. Sometimes they're overwhelmed by greed, and that's reflected in the prices. These shifts are predictable, repeatable patterns in stock prices. So humans are moving from extremes of optimism and pessimism. They sell winners too fast, holding the losers too long. You get these support levels. I think support levels are there because I haven't ever tested this. I think they're somewhat tied to volume. Because what I think is if you have high volume, that means there's a lot of people who bought where they have a price in mind. So if you bought a stock at 90 bucks and then it shoots up to 120, or you're going to buy it at 90 and it shoots up to 120, you're probably thinking next time it hits 90, I'm buying it. Or if you bought it at 90, it falls to 80, you say next time it hits 90, I'm selling it, I'm getting out of it. So those high volume days, I think you sets these kind of round numbers in our mind where you're saying next time it does that, I'm buying, or next time it do that, I'm going to sell it. That sets up these resistance and support levels. What's the support level? The support level is kind of it hits the price and it keeps bouncing off of it. A resistance level, it hits that price and it bounces down off of it. So you're looking for that. That can be a quarter where it's just straight, or it can be a quarter that's kind of moving in an angle. A good way to look at it, we can try this. I don't know if we can do this with your stocks. Do y'all use FinViz? I love this on FinViz. If you don't use FinViz, you should at least get this chart right here. Because I promise you, there's going to be a day in your job where you're going to wish you could show your boss this chart. It's really, really, really powerful. Like this year, you can just show year to date how the tech stocks are really driving this market, right? It's just an incredible chart. But anyway, that's not the reason I'm in here, but yeah, it's a great chart. just finviz.com. But they do a lot of technical charts as well. It won't let me click on a stock. So I'm not sure how far I can get in here because it is a paid site, but we'll see. All right, so here's Microsoft. Well, let me do one of your stocks. What stock you want me to do? Let's do Chipotle because it's been crazy this year. Right, so Chipotle, this is really important from a trend standpoint. You see that gap? So what do stocks like to do when they have a gap? They like to fill the gap, right? Gap, flat, notice a gap. These gaps are really important. You're seeing these, we'll talk about these moving averages. You're seeing some support down here, right? It's bouncing off. So what is this line? What I find amazing with FinViz is a lot of these lines are just connecting bottoms. But obviously they're not doing this manually. So somehow the computer is doing it, but I don't know how the computer is doing it. I'm not exactly sure what the algorithm is telling it to do. I've had to do this at UTSA. We had a boss, we had a CEO that was really into this stuff. And he wanted me to connect them just visually. And so I did, and it gave him a value of 500. And then I did it statistically and gave me a value of 300. It made a big difference. So, you know, it's to me, I don't know exactly how, maybe they did it my way. I did it kind of least squared way to connect the bottoms. But FinViz you could use. I have not seen these type of charts in Bloomberg. So there you go, Dante, you could use this chart to kind of show you there's some support way down here, but they've so bounced off that support. So then you're looking for the resistance, right? Resistance up here somewhere. So you can kind of see this pretty wide quarter because Chipotle's just been all over the place this year. So what's another one of your stocks? Well, has Deere moved much this year? Oh, it has. Wow. That's pretty amazing. So they're on a downward quarter. So you see the support down here. So Rob might say, hey, next, you kind of extend it. Next time it hits this price, I'm going to buy, right? Because it's going to bounce. And it's been pretty consistent, hasn't it? Bouncing off that quarter.
You say support.
Say it louder. I'm sorry. I'm using my hair.
I'm kind of confused, like how you're reading that. Like you say support.
Well, support means when it hits that, it's probably going to bounce up. So you can see how it's bouncing off this level. And then you can see the resistance is bouncing off of this level. Now you might say, well, this is just obvious. Yeah, you can extend these. You notice that it's kind of coming in. So that means something too. It's not parallel. So what happens when these two things cross? That's important as well. So yeah, it's definitely in a quarter. So I mean, these are pretty cool charts. I just don't know how FinViz draws these lines. I mean, it's pretty, I mean, some of the lines are obvious. Some of these are moving averages. We'll do moving averages. That's pretty easy to do. But these lines where they're connecting bottoms and connecting tops, that I don't know how they're doing that systematically, because obviously there's thousands of stocks and every one of them have these lines. So
you're saying one is called resistance line and the other one is called what?
Well, the support line is on the bottom. That's where you're bouncing off of. So what's real important is if it breaks through that support, that's a pretty negative sign. If it breaks through a resistance, that's a pretty positive sign as well. So here, obviously, it broke through, right? And so then you got good support. And then it starts coming down, and then they start. So it always looks beautiful when you look at the chart. When you're actually looking at it real time, that's when you start second guessing yourself. I mean, it's pretty hilarious. I wish I had a video of our CEO explaining this to the exec council. So he said, oh, just give me a chart, Ron. I gave him a chart and he started explaining and he goes, well, okay, well, it didn't work there, but over here. Well, okay, it doesn't work over here, but over, and he said, well, it works, just trust me kind of thing. It's like, it gets kind of frustrating. Give me one more stock.
The little sticks that come off the bars, what does that represent?
Well, what they're showing you is the full range. So this is, do y'all know candle charts? So the candle chart, that's the full range for the day. The smaller box is the opening and close. Right, so that's the candle chart. So you can see that on this day, it moved a bunch, but the open and close, it hardly moved. I mean, it moved a bunch during the day, but the opening and close are almost the same. All right. You can do these charts intraday as well. So day traders, they're looking at this, but this might be 30 minutes. This whole thing, so 5-second charts. You can do everything you can do. And that's one thing people have, technical analysts say is pretty amazing, is the 1 year chart and the 1 day chart look really similar. The patterns and the sport, it's just amazing what they see. All right, give me one more stock just so you can kind of UPS. All right, so that obviously on the way down. So what you're looking for here is something that's going to break out of this corridor, because this stock is just heading down. Now, one thing you see here, there's a little bit of a breakout here, right? You look at that line, there's a little bit of breakout there. They didn't draw this top one. I don't know why. It's a little bumpy. So now the Investment Society has had the guy. I'll have to see if he'll teach this again next spring. He did a great job doing this for the Investment Society this semester. So if I can get him, his name's Jacob. I don't know if any of y'all attend his class.
Yeah, I went to the first, I think it was the second one.
Yeah, he did a great job. He's very prepared and really did it well. We've had a couple of people do these classes. Some have been better than others. His has probably been the most prepared, where he's got everything set up that he wants to talk about. I'm sorry.
Yeah, the breakdown, does it mean that it's like the market is behaving and volatile during that period? When the lines have that breakdown, or what does it mean?
Well, breakdown usually means you're in some pattern and it goes out of it. All right. That's why the Bollinger Bands is so important. So Bollinger Bands is saying, given the volatility of the stock in this, it should be between these two bands. It goes out of the band on the upside. That probably means the stock price went ahead of itself. It went too high, and you're worried about it being overbought. If it goes downside, it's probably been oversold. You may want to buy it. So Bollinger Bands is a lot like RSI. RSI is trying to ask, did it move too high too fast, or did it move too low too fast? So no, if it goes too low, you want to buy it because the market will react. So, and that's kind of what we're looking here. What we're looking for here is a little bit different on support and resistance. If it breaks the support, that's usually a bad sign to say those buyers that were buying, that were bottom fishing, they've given up and they're not there. That's the band. You remember demand and supply, that demand's gone. They see something that says, okay, we were buying on the bottom. It was better. Sorry, Cloudy, it was better on the deer. These buyers, every time you hit this line, they're jumping in and buying. If it breaks down, that demand went away, and all you have is that supply, and they're still selling, it's going to keep going down until finally these guys that got out there, they finally come back in down here. All right. Same thing on the resistance. These people that kept selling at these points, they finally said, you know what, stuff looks really good right now. We're not going to sell this time, and it goes above. So that you see how the supply and demand is what we're looking at here. Because there's people who have an idea that's causing them to do things here, and people have an idea that's causing them to do things, and those people disappear. It breaks out one way or the other. That's the theory. I'm not saying I agree with it, but that's the theory. All right, y'all want to look at one more? Well, that one's been pretty well behaved, hasn't it? Now they drew this line right here. So that's a pretty positive thing. So that they're looking at this. This might be a stock about to break out on the upper side. Who knows? And this is interesting down here. So you see a gap. Anytime you see a gap, that's always interesting because it likes to refill the gap. And that's one thing. Technical people don't like these gaps because it's like the market's like, wait, we need that. Oh, here you go. And there was another gap. Well, we needed that. So. But that's the theory. So anyway, there's so many theories out here. So I'm not a technical expert. That's not my thing. But
you mentioned corridors used specifically for resistance and a support line, or is this kind of a visual trend that you see?
This one's pretty obvious, right? And it's pretty parallel, right?
The UPS one, though, they didn't have a resistance line.
UPS was, yeah. Sorry, Clyde. That was like the worst one. It just.
So do you consider that a corridor on the back end?
Well, why they didn't attach a line here, I don't know. This is not a line. This is a moving average. It's got to be. It's going to be. They're attaching this. Why they decided to attach this and not attach this, that's the part I don't know. I'm not sure. But the computer is doing it. So somehow the computer knows there's nothing here, but there is something there. When I talk to technical people, they talk like it's so obvious. But if you really challenge them, because why? Because they have a chart they can explain. You get them out of a chart they can explain and give them a random one. And that's what Fama said. Fama gave technical people real life charts and he made some up just randomly and they couldn't tell the difference. But they think they can say, oh yeah, look right here. And and I'm kind of like, that's the kind of way our CEO was. It's like he was seeing stuff that wasn't there and then it was. Now you can draw your own and you can do that in Bloomberg. You can draw your own lines if you want to. I preferred to try to do it statistically, to try to do least squares. So when I connected the bottoms, I was getting, the most statistically accurate line. So FinViz can be a source for you. You can at least get a chart that might look really good at the beginning of your paper, just to kind of give an overall trend of what's going on with the stock. And it's black and white, so it doesn't look all that pretty, and there's no way you can convert this. And I don't know, do they have anything that says you can change? You have to, I'm sure they want your money. And you can do intraday if you pay them money. What did they say? It's only $25 a month. So, I probably should encourage this, but if you get a 3-week trial, use it for the class and cancel it. I'm sure people do that. I don't think that's unethical necessarily. They're saying 3-week trial. You might love it and keep it afterwards. Who knows? I can't tell you what you get for paying for the service. $25 a month isn't terrible. It might be worth it. Davis Research is better, but real expensive. So here's one that might be worth it to try. I mean, if one of y'all tried saying, wow, this is incredible, I could always go to the library and say, hey, maybe they have a university function that we could put in there. So who knows? All right. So that's the theory. Resistance, it's all about supply and demand. Some supply disappeared, some demand disappeared, and it caused the lines to break out. Now, Charles Dow, he did not do Dow theory. Someone came after Dow and wrote it all down. So Charles Dow, he's the guy who's the Dow Jones. You could read his history. He was doing this stuff without computers because, Charles Dow, I don't know when he died, but I think before World War I. (1902). So you kind of they probably have a link to the Dow theory, right there. They have a link to Dow theory. And you see the word trends all over the place because that's the key to this analysis. So he was somehow doing this. How he did this without computers, and I don't even know if they had the ticker tape. Y'all seen the movies with the ticker tape, right? So I don't know exactly. I think that was a telegraph line, wasn't it? And there was someone was setting prices. So I don't know exactly what he did. He's probably at Wall Street, probably had runners going and getting prices, but I don't know. Wouldn't you love to see a video of what he was doing every day to figure all this stuff out? But he says there's trends. There's the uptrend, there's the top of the trend, there's a downtrend, and there's a bottom trend. But the problem you have is there's true trends and there's fake trends. And you got to find the true trends and avoid the fake trends. That's the whole theory behind this. There's retracements where markets are kind of going back to where they were. There's consolidations where it kind of goes sideways for a while. That kind of gives you a floor. So there's primary trends, secondary trends, and noise. Primary trends is what you want. So you have early investors coming in. They're starting to show patterns. A lot of times the early investors are the institutional investors, the most sophisticated investors. Then you have the middle investors coming in, the less sophisticated ones. They're responding to news and current earnings. So the early investors, they're responding to stuff no one else has. They're kind of the inside people, the most sophisticated. The middle ones are responding to what everybody has, but they're fairly sophisticated. And then you have the retail investors at the end. And I had one student, she wasn't a finance major, she was in my EMBA, and she found this really upsetting, saying, y'all make money by taking advantage of the small retail investors? Like, yeah, that's how they. I mean, what does Robinhood do? Isn't that what Robinhood did? Are selling the retail investors' data to sophisticated investors. They're taking advantage of the small guys. That's evil. I said, well, the small guy doesn't have to do that. You know, the small guy doesn't have to go to Vegas and bet their money. You know, so it's it's a free world. And if the data tells you something, she's like, oh, that's just not fair. But anyway, but that's kind of the thing. It's not just supply and demand, but it's a type of supply and demand. Retail investors are the worst, and they tell you when the end of the trend is happening because they're the ones that jump in at the end and do the stupid stuff. The secondary trends, these are the ones that look like they may be a trend, and then they fool us. They're not really a trend. And then noise, this is what the retail investor is responding to. So Dow says err on the side of being late, so you don't find one of those secondary trends. You're better off reacting late, making 10% instead of 14%, so that you avoid that secondary trend. So that's his theory. Now, I had a student go to one of those, I don't have a TV anymore, but I bet the commercials are still in on the trading models that you can buy. You're using meeting at some Holiday Inn conference room. I had one student do that, and he came back and he says, yeah, it was just Dow theory. They're just selling Dow theory. You could do yourself. You could probably get it for free on the internet. So yeah, fine. So the one I'm requiring you to do is moving averages, because that's the one you see everywhere. You're seeing that all over the place in FinViz. These are all moving averages. So we'll talk about them. Moving averages is really looking for momentum. Does the market have momentum? So the one I'm going to show you is the one we did at USAA. So I'm giving you away our trade secrets because they don't do it anymore. So it uses the 200 to 100 and 300 day moving average. And what we said was, if the price is above the 50-day moving average, the 50-day is above the 100-day moving average, and the 100 is above the 200-day moving average, you're in the stock. If any of those are not true, you get out of the stock. So anytime if any one of those crosses, if the 100 crosses the 200, if the 50 crosses the 100, if the price crosses the 50, anything crosses, you sell. All right. Now the question is when. You talking intraday or close? If you're talking intraday, this is a real pain because you got to be sitting there watching every single second of the day. If you got a 15-minute delay, like our Bloomberg machines here have a 15-minute delay, what do you do then? At USAA, we didn't have the 15-minute delay. We had the markets as is because we were paying more. We have a cheaper version here. But still, I don't want to sit there all day long watching this. So you'd have to have the computer doing that for you and somehow signaling you that a trade just happened. And how fast do you want to be? What if it crosses for 2 seconds, it goes back? Do you have to sell then? You have to make all those decisions, right? So it's a little tricky. So we're going to use closing prices just because that's about all we have. All right. So let's just do that. I'm going to show you how simple it is. You're going to be amazed how simple it is. So what stock do you want me to do? So give me one we haven't done yet. You want to do floor and decor, which is really just floor, right? What decor do they do? Do they sell anything? Silk flowers or something? So you get historical data. You can do this in Bloomberg as well, but you can do this as well. Just here, how far back do you go? I'm going to do max, but you really don't want to do max. Yeah, but you're not going to do more than a year anyway, so it doesn't really matter. Okay, where did it go? Download, where are you? Download, there it is. I did it twice. All right, so you do a 50-day, 100-day, 200-day. We're just going to do close. And you actually want close, not adjusted close, because this is on the actual price. I think volume is important. Now, to me, high volume days, that's when you get those resistance and supports, because that's big day when people kind of have a psychological number in there. And so 50, you got to find 50 days. I'm gonna put this over here. Well, wait, let me copy it down first. So 50 days, it really is. Wait, what did I do? Whoa. I don't know what I did. All right, that's interesting. It's like, well, how does 50 get in there twice? All right, so 50 day, you just do equal average 50 days. I mean, can you believe it's that simple? 100 day, guess what you do there? Now, there are exponential averages where they're kind of relying more on more recent. You're kind of weighting them, but I'm not asking for that. You can use that. Any moving average works, but a simple moving, this is a simple moving average. You'll see it like an SMA. Let's do year to date, all right? So I'm gonna go here. Year to date's probably too much as well, but we'll do year to dates. So all you do is you just graph it out. I'm gonna add in the dates. Here you do want the actual dates, so don't do it by year. And then the next thing you want to do is you got to get rid of as much white space as you possibly can. So I'm going to start at 70 and go to 120. Whoops, I typed something wrong. I'm going to go to 115. Yeah, there we go. All right. Do y'all see a quarter in there? And look at that. You got a pretty good one there. All right, so if you look at the moving averages, let's mark it here so we know what we're looking at. So this is the stock. This is the 50 day. Now you don't have to do it in Excel if you want to get it out of Bloomberg or get it off of FinViz. You can. You don't have to create it yourself, but 100 day. Right. So if you look right here, the 50-day cross. So you can't buy here. Why? Because the 50 days is the lowest. Okay. The 50-day cross at the 100-day, but you still can't buy here. They have to all three be above each other. So here you can't buy either because the 200 days above the 50. So where can you buy? You would buy right here. When the 100-day crosses the 200, y'all see that? And where would you sell? Sell right there. When would you buy again? Buy right there. And you're in there for a while. Here you've got a little bit of, it's kind of bouncing off its 50. So there you would sell and buy, right? There it bounced off. What would you do right here? You'd sell, right? When would you buy again? There's one other thing that he added when we were doing this. This last little bit, they all have to be rising. Okay. So what's your problem right here? It's hard to tell if the 50 is rising or not. You'd have to look at the 50-day average today versus the 50-day average yesterday. If it's higher, you can buy. If it's lower, you can't. All right. You can see everything we had, and we had to have all this in an Excel spreadsheet and watching it closely. It doesn't look like to me that it's rising. At some point, if the 50-day starts rising, you would buy it again. Hopefully you buy it before here, right? So here you would definitely you'd be in here somewhere in here. So the advantage, can y'all see the 50 starting to rise here? So somewhere in here, but I can't tell if the 100 days rising. So they all have to be rising. So it's just really, really frustrating. But somewhere right around here, you would buy it. But would you have gotten this? That's where you're kind of. I've seen some people do the models where they say, "Hey, at cross, I'm buying," but they know that after close. But you can't buy at close after close. The best you can do is buy it open the next day. So that's the other decision you got to make. So you might say, okay, right here's where we go, but the market's already closed. So my rule is I'll buy it at open the next day. But what if open the next day, it's opens 5% lower? What do you do? So y'all can see it's not all that simple. So every time he gave me the rules, we had to say, this was head of equities was doing this. Every time he gave me the rules, I'm like, well, what if this happens? What if this happens? He's like, Ron, shut up. You're making my life. He had one model, it was so incredible. He's showing me, look how great this works. And I go, Stuart, you sold on Friday before Black Monday, but you didn't know to sell until after the market closed. But so you didn't actually sell on Friday. You were actually selling on Monday when the market's down 20. He goes, oh, I'll fix that. So he changed one of his ratios so we sold a few days earlier. It's like, yeah, that's you're data mining. That doesn't quite work. So it gets frustrating. You got to be really precise on this, because if you're not, what are you going to do? You're going to keep rethinking. You're going to let your emotion. The key to this is there's no emotion. You got to know exactly when to trade. So if you're going to say, hey, if the 50 days higher than yesterday, I don't know that until after close, but once it does, I'm buying the next day at open. If you're going to say, unless opens more than 1% away from close, you got to make those decisions today. Don't make that while you're going, all right? So how long are your rolls going to go? If you end up with 17 pages, you're going to be a little frustrated. And all of that's got to be computer driven. The advantage of saying once it crosses, we're going to buy it open the next day is you have 12 hours to think about it and you can watch it. But you've seen some of the stocks with earnings announcements moving 4 or 5% overnight. So the next day open can be radically different than the previous day close. So all of that's got to be in there. But you're definitely in the stock somewhere in here. When do you sell again? When do you say the sell point is? It's hard for you to point it out. Would it be here? Would you sell there? Yeah, right here. So you lost all of that. So the question is, where did you buy over here? If you bought here, you're pretty happy, but you can't tell if that's rising or not. If you bought here, you're pretty happy, but then you're all the way back down here. You would have gone from there to there, but if you bought here, you'd be pretty sideways. Here, you're out the whole time. Do you get back in again? Never get back in again. So you say, wow, that really helped me. But the question is, where did you sell here? You didn't sell right there, did you? Right? Because that's a close number. Where did you sell? If that dropped, where did it drop? That's a pretty important point where open versus close, close versus open is, isn't it? So technical people, it's like, yeah, look, see how it helped you here? It's like, no. Tell me exactly what you did on that day. Because there's a big difference in that little line there. And that's a big problem with technical analysis. You get these discontinuous markets. It looks so obvious that helped you, but you got to know where you did it. Here, you're kind of upset you didn't get that, but you're just out. This is not a. So if I were doing this stock, the way I talk about it, Jose, is this stock has lost momentum, especially on a short-term side. The 50 days is crashing. There's no momentum here. Why? Because these days are still in the 50, and all of this is just dragging it down. You're going to start noticing the 50 days is going to start bottoming because of this big thing here. But the 50, the 100 and 200, they're still well above where you are. And that's what we mean by momentum. So the 200 is the long-term momentum. The 100 is kind of intermediate. And the 50-day is a shorter term. You can do a 10-day moving average, a 20-day. I forget what FinViz does. I think they do shorter terms. Where is FinViz? So FinViz is doing 20. The purple is 20. So UPS, what kind of momentum does UPS have? Very horrible momentum, right? The 200-day is down. Everything's just down. So UPS has horrible momentum right now. This is not This is not a time to get into UPS stock. So Claudia may be, her papers run through 8. She might be saying, or 1 through 7, she's saying, this is the perfect stock. It's undervalued. It's wonderful. However, this is not a great time to buy it. It has no momentum. Now, anything excited about this down here? Maybe something's going on. Crossing these moving averages is exciting. They cross this 200-day or 20-day. It's coming up to its 50-day, but it's still way away from its 200-day moving average. But some investors say, forget the 200-day. I'm just worried about the short term. They're kind of the anti-Dow. They're saying, you know, Dow's saying look longer term, wait for more evidence. But yeah, Claudia, you got a stock where the market's just like there's been a lot of downward pressure on this stock. Right. This is not a great stock. Year to date works pretty good on them. They can, you know, Juan Carlos and Jose can certainly say early in the year there was some pretty strong momentum, but it was pretty sharp rise. Your Bollinger Band might show this stock overbought at those two places. So while there's good momentum, it may be overbought. That may be telling you to avoid it, that it is probably going to fill that gap back in, and it certainly has. So this is an important point right here. It crossed the 50, and it certainly has gotten out of that quarter. You can see how it's gotten out of that quarter. I tell you what, this is a FinViz chart, isn't it? We should have started with floor and cord. So you're seeing this longer term trend, and you see that incredible. That's pretty material. Something just happened. Now, did they have an earnings announcement? Why did it do what it did? So if I were you, I might want to go back and look at this day and see why did it move on that day. Now, remember in Bloomberg, if you type GP in Bloomberg, you can click on it to put key events for news, and you might find a news event on that day, and you can click on it and see why it happened. So that GP function in Bloomberg, you just say, put in key events and add the news. That can be powerful. There'll probably be a news article, some articles, why did Floor and Decor move so much on this day? So Bloomberg can really help you on that. Yeah, you're seeing the same thing, right? The exact same chart we just showed with the 200-day just coming down. So could you use this for your momentum? Yeah, as long as you talk about momentum. So you can use FinViz. You don't have to do it in Excel. You can use FinViz, but you got to talk about momentum. It's got to be part of your discussion. Does this stock have positive momentum, negative momentum? Is it consolidating? Is there obvious support levels? Those kind of things is what you're looking for. I say draw lines or use FinViz. You know, let them draw the lines for you. So regression must be what FinViz is doing. I don't know how they're doing it. So moving averages are looking for resistance, support, breakout. So, you know, anything that says something's happening. There's some supply demand thing that's going on that's caught this stock starting to start a new trend. So Dow would say, is this a new trend or is that noise? Or is that an intermediate one? You have another gap here, another gap here. We haven't filled this gap, have we? So is that just out there hanging? So, you know, what's going to happen there? So anyway, they do. Oh, this is interesting. They do put the earnings out there. So the earnings was here. So this gap is not earnings. Something else went on there. Maybe it's interest rates, right? That might be tied to the CPI number coming out. What day did the CPI come out? I can't tell what day that is. That looks like that could be it, right? CPI come out on Wednesday, cause interest rates to nosedive. You would think Floor and Decor would be really worried about mortgage rates. I don't know if y'all have seen that in your discussion. So maybe that's what it is. Is that enough to break it out? If interest rates keep doing this, yeah, that could be. It could be a very systematic thing. All right. Questions on moving averages. You can also look up simple moving average on Bloomberg and see what they say about it. And, you know, get some discussion on that. Y'all got momentum, pretty simple concept. And does it work? I think it must work because Cliff Asnett believes in. Fact, fiction, momentum investing. He writes articles. What's interesting about him, I was listening to a podcast and I highly recommend his podcast. They're so good. He tells the story of when he did his dissertation for his PhD, his professor was, I just forgot his name, Eugene Fama. And he did his paper on momentum, something Gene Fama doesn't believe in. So he's like, I'm doing my paper on something you've written about doesn't really work, that it's all just fiction. But he got it and he got it approved. Eugene Fama was like fine with that. And he let him get away with it. But it's funny listening to him talk about that. So Cliff Asness is a huge believer in momentum, and I'm a huge believer in Cliff Asness, a very smart guy. So if he says it works, it works. And he says momentum works. Not only does he say that, but GMO, they're a big momentum company as well. So their big thing is quality and momentum. Those are the two things. So there are some very impressive, very skilled investors out there that absolutely say momentum works. It shouldn't work. Something that simple shouldn't work. It's something as simple as a stock whose price is higher today than it was 52 weeks ago. You should buy it because it's going, you know, it's so simple. All right, sentiment. A contrarian technical analysis, what they're looking for is what is everybody saying and do the opposite. Why? This is the small investor. The articles that come out, they come out for the small investor. Because the small investor is scared to death. They want to read articles about how the world's coming to an end. Right? Because they need a reason to sell. They haven't sold. They've lost 30%. And so they're not going to read articles about this is the end of it. They want to read because their psyche is like that. So newspapers write those articles. And then the small investor finally sells. And that's when you start seeing odd lots. Because what is a small investor? They're odd lot trades. They don't trade 10,000 shares, 100,000 shares. They trade 27 shares. So these odd lots, that's when you're a retail trader. So again, we're taking advantage of this retail trader because we know they're the worst investors out there. They sell at the bottom, they buy at the top. So my boss was one of these. We had a $300 million trade at the bottom of the market. He calls me and says, yeah, I don't think we should do it. I was reading an article today. It's like, we've talked about this, you know, it's just so frustrating. But yeah, I read an article this morning. Yeah, I'm like, yeah, that's when you read articles at the bottom of the market. That's when they come out. Put call ratios. Puts are bearish, calls are bullish. You can look at the volume of puts versus calls, and that tells you sentiment. Short interest is another one. Mutual fund cash holdings. Why? Because that's more retail than it is institutional. If they're holding a lot of cash, that probably means the sentiment is bullish. I mean, it's bearish, so you should probably be bullish. Margin balances. Again, the retail trader. When they're really optimistic, what are they doing? They're borrowing a lot of money and buying stocks. That's probably the end of the market. Advisors are the absolute worst. What do advisors do? They don't know what's going to happen. So they're talking about whatever is currently going on. Because no one wants to be the contrarian when you're an advisor. It's like the lady at my church I talked about in 2000. Ron, how can I get my advisor to buy tech stocks? And I told her, well, you know, tech stocks are like grossly overpriced. And she looked at me like I was an idiot. It's like, oh, I'll go find someone that knows what they're talking about. She wanted someone who's going to do what the market was doing, because that's the psyche of a small investor. I hope she didn't go out and buy tech stocks. It would have been a disaster. But yeah, that's what advisors do. Their customers don't want to hear that, used to be buying in this, and used to be buying in, December of 2008. No, no one's buying. I've already lost so much money. No one used to be buying. They just don't want to hear that. So that's the sentiment. There are a lot of ways to get sentiment. Ned Davis does a really good job on sentiment. You can just actually go on Ned Davis and just type the word sentiment, and some ones you would have never thought of that are, they obviously have the put call ratio. That I don't know if FinViz does that. There's probably some, there are probably some websites that will give that to you. So, you can certainly look that up. I'm not sure about Bloomberg. You might try it on the Bloomberg under their tech to see if they have that. It's an interesting one. The key here is that it's a little bit limited because it's kind of trying to call tops and bottoms versus trends. So it's more of, you're looking for the end of a trend, right? When the retail investor starts doing stupid stuff. So it's kind of an end indicator. Market strength. This was a huge one in 1999. So in 99, the market was rising, strong market. And then you looked into it, and it was actually only a few names that were driving it. Very similar to what we're having today, isn't it? In fact, it's amazing what we're seeing this year versus 1999. In 1999, it was a few growth stocks that were driving everything, and small cap were doing terrible. What are we seeing this year? A few growth stocks are doing everything, and small cap are doing terrible. It's almost exact. And then what happened in 2000? The tech stocks sold off, and small cap did okay. If you had small cap stocks, you hardly even noticed the 2008 sell-off because they did okay. I'm still heavy in small cap. I'm kind of that retail investor. I'm going to stick to it with the end. But I do think small cap are incredibly cheap right now. And we're in this market where now if we have a recession, especially small cap value aren't going to do well. So I realize I could be, catching a falling knife, but they're so cheap. And plus GMOs are saying the same thing. And so I'm kind of jumping on their coattails. But that's that market strength. Yeah, the market's up, but there's only 20 stocks that are driving it. The other 480 stocks are just not doing anything. That's not much depth to the market or breadth. So what do you look for here? The advanced decline line. How many stocks are advancing versus declining? If just the biggest, most expensive stocks are going up and everything else is going down, that's an indication that this market does not have much strength to it. How many stocks are hitting their 52-week highs versus 52-week lows? That's another one you can use. That's a pretty easy one to do. Advanced decline. Oh, here's a Ned Davis chart up there. That's kind of interesting. So this is what Ned Davis does. This has got to be Ned Davis, unless someone's copying their line. So yeah, so if I don't see Ned Davis in there, but that's real similar to Ned Davis. So some of the stuff, this doesn't help you with your stock. You can't do advanced decline for your stock. This is more the stock market. So it's more a high level kind of thing. So compare large cap to small cap. This year, large cap are doing well, small cap aren't. Now, last year, it actually helped me having small cap value. They were down, but not down nearly as much because the tech stocks were all selling off. Dow talks about transportation and industrials. And he says they need to confirm each other. Now, whether that's still true today. Now, he's doing transportation in 1880. I don't know what that is other than ponies and trains, but there were no planes, there were no trucks, so I'm not real sure exactly what, or maybe steamboats. And industrials, I'm not sure exactly what he was looking at. So there are some others out there that I've seen. Utilities have been really, really interesting, but they give a really strong indication. I saw a CFA luncheon where he was saying utilities tell you a lot. So I don't know if that's still true today, but people have started looking at that. Certain segments of the market do certain things at certain times that tell you what's about to happen next. These aren't going to help you with your paper 8 because they're industry, they're stock market level. They're not company specific. But just these are kind of things that that Dow was looking at that you can look at. Where you have to be careful with it with technical analysis is the data mining. There's billions and billions and billions of pieces of information. There is data out there that is perfectly predictive historically by pure random chance. When you have billions of pieces of data, there's data out there that has an R squared of 100%, and it's just pure random noise. So one of our former students spoke to my P&C class, and I can't remember the guy's name, Nick, a famous actor. He did the Declaration of Independence search. What was that guy's name? Nick, I can't remember his name. Gage, yeah. She said you can predict the number of auto accidents by how many movies he makes. And it had a R squared of 100%. Does that sound like something you would want to bet on if you're a property and casualty insurance company? Probably not. Probably just random noise. You've heard the ones like the NFC wins, the stock market's going to be up, those kind of things. So you have to be careful that you're not relying on data mining in what you're looking at. What I love about Ned Davis is that they give you the full history so they can show you the key here is when you back test something, make sure you leave yourself some data you didn't back test because you need some out of sample. Right, that was kind of the problem with the guy I was working with at UTSA. He used 100% of the data he had and said, look how perfect it is. But he could have just been fitting that particular data period. So what he probably should have done is run the 90s and he got his pattern and see if that would have worked in the 80s or see if that would have worked 2000, 2005. Now, what do hedge funds do? What hedge funds do, and I actually saw this, is really incredible at Deutsche Bank. I visited their hedge fund because we actually hired their hedge fund. The first hedge fund I ever purchased was a Deutsche Bank one. And it was a room of 7 scientists. None of them were finance majors. They did nothing but look for stuff all day long. And if they found the pattern, they would then test it out of sample. If that worked, they would then do an incubator fund, which means they would do live money, but not to a client. And their out of sample was, guess what? It was the future. They would test it with live data going future. If that worked for 2 or 3 years, they would then take it to the client. That sounds like a pretty cool job. It was pretty boring. They're all just like, what are you working on? And I've been working on this for like 7 months. That one thing, yeah, 7 months, and it's really not working, so I have to go find something else. Well, they paid you for 7 months to find out that that one thing doesn't work. So yeah, man, you got a really interesting job. Now, eventually I got to come up with something, but yeah, I mean, maybe they're working on one, maybe they're working on 3 things, but it's pretty interesting. It was very quiet and everybody's whispering for some reason. Brainiacs, some of them have PhDs in math. It was really, really interesting. So you back test it, but you got to make sure you have some out of sample. Now, some out of sample can be, and you'll hear this from Cliff Asness, that works in the US. I wonder if it works in Europe. You can out of sample it in another market. Or that works with large cap. I wonder if it works for small cap, right? So, and then once you find out that it works, you also have to have some rational reason. Now, this is a little different from what Dalkash was saying for technical analysis. So her only reason was, we don't know the reason, but we're just assuming it's supply and demand. So she's not going any further than that. But I gave you some explanation. It's the institutional investor versus the small investor, the retail investor. That sounds like something that could stay there. And then the last thing you have to have is you have a reason for why it works. Will it continue? And this may be where AI messes this all up. Because what I'm worried about, well, not too worried about because I'm retired. What you should be worried about is when AI is competing with AI. So right now, AI is trying to figure out human errors. What happens when AI is trying to figure out AI's errors and they're all competing with each other and we're all just sitting at home doing nothing? I don't know what we're doing. So it's going to be your strange world that you're going into where you have computers competing against computers. But right now it's humans competing against humans trying to figure out mistakes humans make. AI is going to figure that out nano fast. And then AI is going to be doing it. So it's going to be pretty interesting. All right, so some of the favorites that you can do. You have to do moving average. You can do simple or exponential. Simple is just SMA. RSI is really popular because it's so simple. All RSI is looking at is you have some ratio. It's a pretty easy ratio. You have to define your standard deviation and how far away you are, if you're 1 or 2. And also looking, if you go above, and then it goes above and then comes back and hits, you want to sell. So it kind of, maybe I can show you an RSI. So if it goes above, what you're looking for is when it hits and coming back down. That's where you want to sell. If it goes below, what you want to do is when it hits to come back up, you want to buy, right? So what they're saying up here is it's overbought. So you want to get out. So, and Bloomberg will explain all that to you. It's just the simplest one because you know exactly what to do. The problem with the RSI is I don't think it works. If you go back and look at stocks and say, well, if I'd done it here, oh, that would have worked. Well, if I'd done it, oh, that didn't work. So you're kind of, I don't think it works. Bollinger Bands to me are much more interesting. I really like them. A lot of students do Bollinger Bands. It's simple. It sounds sophisticated, but it's simple. The chart looks really, really cool. And it tells you something that gives you something you can really, really talk something about your stock, give some really good insights to your stock. But it's essentially just taking your stock and it's putting standard deviation around it, which is going to change, right? Because your stock gets more or less volatile. It's real similar to RSI, but it's looking if it goes above that line. So it kind of gives you more stuff to work with. Trend lines, we just saw that. Trend line to me is part of your moving average. So really make that part of resistance, support, ranges, breaking out. That's part of the moving average. The MACD is pretty popular as well. It's real similar to RSI and Bollinger Bands. I say the BTST function, but I now use TEC. TEC's easier to remember. I don't know what BTS stands for, so I changed it to TEC. There are some websites that are giving you, FinViz is one of my favorite, but there are some others out there you might try. The advantage of these is they'll give you specific charts for your company, which is kind of nice. Or you just go to Bloomberg. Bloomberg will do that as well. But if you don't want to come over and do Bloomberg, you can use some of these others. The advantage of Bloomberg is I like their explanation, I think is a lot clearer. But some of these other might give you, I don't think FinViz gives you a definition. FinViz, you got to know what it is before you do it. And FinViz is a little bit more limited. So, so what I'll do, so we got to talk about what we're going to do. So we've got 3 classes left. Is that correct? I think. Right. So what I was thinking about doing is next class I'll be here, but make it a paper kind of work class because I know it's Thanksgiving coming up and we are enough ahead. We need one more class on technical analysis, but we can do technical analysis and the executive summary. I think I've given you enough on technical analysis. You can kind of go with it, right? What I'll show you here in this class is a few example charts. You're going to see them anyway, so we'll just talk through them. So that's kind of my option to you is this can be, especially those of you that are behind, if you can come, I can help get you caught up. So not an official class, but I'll be here to do one-on-one help. And then we'll finish up with the exec summary and technical analysis, the last 2 classes. Would that be okay? I've never had students say, no, we don't want to walk. So I haven't had anybody say that yet. So the only negative of that is I'm not talking about the exec summary until right before it's due, but you still have like a week, right? I need everything by December 9th. So you'll still have a couple weeks. So we should have plenty of time. All right. Now, would anybody want to come next Tuesday? Am I going to just be here all by myself? So Allison, so what we'll probably do is meet in the FSC, not in here. So I'll put that in there. The other thing is I don't have any grading this weekend. So this is also, if you're behind, you need, I'm not going to come up here over the weekend. I'll be here Monday. So Monday, 1 o'clock, 101. So if you need help on the paper 7, you need help on the forecast, whatever you need, we can get you the data, make sure you're ready to go. So over Thanksgiving, you're getting those in. So you got papers 5 and 6 due next week. Get those out of the way. So, this is a good weekend. I do have to teach EMBA Saturday morning, so Saturday's a little busy, but yeah, I mean, Sunday really, really open. I don't have any meetings Sunday afternoon, so you contact me. I can help you get caught up. I won't write the paper for you, but I can certainly help you get to where you need to get so that we're not too far behind. All right, questions on any of that? So next week we'll do a little bit more. I mean, after Thanksgiving, we'll do a little more on technical, and we'll do an executive summary, and then we'll finish up a little bit. I was going to do portfolio management, but I think what I'll do is the last class, we may be able to finish everything in the second to last class. In the last class, I want to talk about the industry and just what it means to work in this industry, what you're looking for, kind of thing. Now, I'm a little unusual. I was a security analyst for 9 months. And then I became a portfolio manager. So I was kind of on the fast track, but I can at least talk about what I did for those 9 months. So, all right, we'll stop it there.